Welcome to another edition of the Sentinel video series, this one on the wonderful world of credit. Well, what exactly is credit? If we use a couple of dictionary definitions, one says it's a belief or confidence in the truth of something, with a special emphasis on confidence. Another dictionary definition says it's a reputation for solvency and integrity entitling a person to be trusted in buying and borrowing, with an emphasis on borrowing. And finally, an accounting and bookkeeping definition would be an entry of payment or value received on an account. The Sentinel has postulated a series of economic laws. Our economic law number 1 states that credit equals confidence. Without confidence, there is no credit. And as we saw earlier in the dictionary definition, it is a belief or confidence in the truth of something. In this case, it's the belief or confidence that a loan that's made will eventually be repaid. Where does credit originate? There are a few examples on this page that list some of the sources of credit. $0.9 trillion of credit is involved in revolving credit, which is typically credit cards. There are about $3.8 trillion in credit created by commercial banks for the purposes of residential mortgages. And we all know about Uncle Sam's credit, presently up to $12 trillion and counting. And this, of course, does not count some of the unfunded liabilities associated with Medicare and Social Security. About $1.6 trillion is in non-revolving credit, things such as automobile loans, RVs, vacations, etc. And as we mentioned earlier, in commercial banking, there are approximately $9 trillion in loans for various things. How does credit come into existence? In order to understand this a little bit more clearly, why don't we start a bank? In order to start a bank, we'll need some cash, which will be $1,000, and some equity associated with that cash, which we'll call the Sentinel's equity, which is $1,000. And as you can see, this has been laid out in an account ledger form with assets on the left side and equity and liabilities on the right side. So our assets are the cash that we started out with, $1,000, and our equity is the ownership of that bank, which is essentially the Sentinel's, which is also $1,000. Assets must match liabilities and equity. Now that we've started the bank, let's go ahead and get into business by making a loan. A friend of ours, Ben, needs a loan for $900. We go ahead and extend the loan to him for 10% simple interest for 1 year. So at the end of 1 year, Ben's going to return to us the $900 that he borrowed plus $90 in interest for a total of $990. As you can see on our ledger, our assets, our cash is now $100 since $900 of that went on a loan to Ben. That $900 loan to Ben is still an asset. And our equity still remains the same. We don't have any liabilities as a result of this loan. I want you to look at something very closely though. Even though we extended a loan to Ben, we really didn't create any additional credit money since the total assets still equal to $1,000. So if you can consider a very simple example in this economy, or in this banking economy, the total supply of money is still $1,000. 1 year later, Ben repays the loan. Our cash is back to the original $1,000, which is the 100 plus the 900 we had from Ben in the loan, and Ben has returned $90 in interest to us. So now our assets are $1,090, whereas before they were $1,000. And of course our equity increases also by $90 to $1,090. Something else that banks do, of course, is accept deposits. Timmy wants to deposit $5,000 in our bank, and so we create a non-interest-bearing checking account for Timmy. Now our assets have increased by $5,000, which is the amount of Timmy's deposit, but our liabilities have also increased by $5,000 since we have a checking account that's available for Timmy, and essentially those $5,000 that he deposited can be available to Timmy on demand, hence the term demand deposit. Here's another example of something that banks do, and that's raising cash or capital. Let's say our bank wants to expand its cash holdings. What we do is we sell 100 shares of stock for $10 each, thus raising $1,000. So those $1,000 then represent new assets, so they go on the left side of our ledger, cash from stock sale. Additionally, we have new equity owners in our bank, which are these new stockholders that also have $1,000 of value as part of the overall equity of the bank. Now we have total assets of $2,000 and then total liabilities and equity of $2,000 as well. In this particular case, we don't have any liabilities, but we've increased our stockholder equity by $1,000. Let's show an example of an actual creation of credit. We'll go back to the slide that indicated our cash on hand plus Timmy's deposit of $5,000. Now let's say the bank wants to expand its loans. Our friend Ben this time wants to borrow $5,000 at 10% simple interest for 1 year. So at the end of 1 year, Ben returns $5,000 plus $500 or $5,500 to our bank. We now have a new asset on the left side of the ledger, which is the loan to Ben, which is $5,000. We also have an additional liability derived from that loan in order to balance both sides of the ledger, which is $5,000. An observer might ask, well, how is it that we can loan Ben $5,000 when we really only had $1,000 in cash available to us for loans? We also know that Timmy's deposit of $5,000 can be called back at any point in time because it is a demand deposit. The loan to Ben, however, is over the course of 1 year. So if Timmy were to come back and ask for his money all at once, we might not have enough cash to provide him for his demand deposit. So this is an example of what is known as fractional reserve banking, where you actually loan out more money than you have actual cash on hand. The loan to Ben for $5,000 essentially becomes that credit or that increase in the money supply that before was not present. Extending this concept further, let's look at what happens to Ben's money after he receives the loan from our bank. Well, Ben essentially can deposit that check from our bank into his bank, and that bank would show an asset, which is again Ben's deposit of $5,000, and of course a liability associated as well, because that $5,000 could become essentially a demand deposit in that bank. And that bank, of course, has the same ability as our bank to create new credit. So let's look at some salient points associated with the last example of the loan creation. In that example, the bank vault only had $1,000 in cash that would then support Timmy's checking account deposit of $5,000. Having less than 100% cash to support the immediate liabilities is an example of fractional reserve banking, which basically says the bank only has a fraction of the amount of money required to support demand liabilities, in this case Timmy's checking account. We know the loan to Ben was inflationary since the money supply increased as a result of the loan. Those $5,000 that were loaned to Ben really didn't exist because that money was created out of thin air. Ben's bank increases their assets and thus can make more loans. The bank really only had a maximum of $1,000 to loan, the initial equity cash, but in fact it loaned $5,000. As we mentioned earlier, the bank creates that money for the loan since there is not $5,000 to loan. The resulting increase in the money supply in the economy creates additional demand for goods and services, which is, of course, is inflationary. If our previous example was inflation, then what exactly is deflation? In another of the video series, the Sentinel presents a segment called The Destructive World of Deflation. As you would imagine, deflation would be associated with a reduction or a destruction of credit, and we show some examples associated with credit cards or maybe even bank destruction of credit as well. Thank you for watching this video on the wonderful world of credit. This video was brought to you by the Sentinel. You can catch us at www.thesentinel.biz. Our purpose is to educate readers on investment topics and economic trends. We know that there's oceans of information available. How much do readers truly understand from that information? We think that investment failure is often a result of misunderstood information and ability to identify changes in trend. Since people typically invest in a herding-like manner, that type of crowd following can really be deadly during trend changes. Rather than simply telling you what to do, we try to explain the reason for taking specific action. The explanations that we provide are given in historical context with some contemporary examples. Such an approach then applies reasoning to investment action as opposed to the herding instinct typical to most investors.